watching closing trades right here in
I thought you
80
were not
now.
ready.
Sorry,
I
what?
thought you were not ready. Aisha is always ready.
Always. Yeah, so for the markets, we've done actually nothing. We've just consolidated today. Although we are at the lower end of the range, at least intraday. But again, no alarm bells really. We're down only about 35 odd points. And optically, we're still above that 18,600 mark for the Nifty futures. 18,600, of course, on the spot has been acting as a tough resistance like we've been marking. While yesterday it was autos and select banks which were actually holding up, today it's really all about cement. So from the word go, beat an Ambuja which is holding up in excess of 4.5%, Shree Cement which is higher than 3.5%, ACC up 2.5%, Ultratech, they're all holding very smartly. And by the way, it's not just these large cement companies, even the smaller ones. Across the board, you are seeing a synchronized move come in. So that said, the breadth of the market as well is pretty much even Steven. We've been flickering in and out of the red to the green for the market breadth as well. So that said, it's actually mid-cap IT which is the trouble point today. Remember the EPAM report which came out, and you had globally as well some of the Nasdaq stocks sell off. That's kind of rubbing off on the mid-cap IT pack today. So Persistent, Infosys, Coforge, Birlasoft, these are the ones which are falling hard in today's trading session. In fact, the cut on Persistent is as deep as 4.5%, and it's no different, by the way, for even the large cap IT names. Infosys is down 2.5%, TCS, Wipro, TechM. They're all feeling the heat a little bit. But I don't think anything changes for the market texture, Nikunj, overall.
Seventh day now and a 200-point range.
Yeah.
I think this is one of those ranges where you know directionally markets want to go higher, but there is some impediment which just chokes the market from going higher. There's nothing wrong with the global market. There's nothing wrong with the flow picture. Then why are markets stuck in a range, and for how long they will remain stuck in a range? The more markets consolidate, the healthier it is. That means bigger is going to be the breakout. Kunal, am I making sense? 7 days, directionally markets want to go higher. The longer you consolidate, the more chances of a sharper breakout.
See, when you look at this from an index point of view, yes, it makes a lot of sense that the indices are getting ready for a breakout on the upside. But the reason for the markets pausing time and again is because there are no large cap stocks which are showing a rip-roaring move. And typically when you see the index closer to the all-time high levels by a couple of percentage points, you would actually believe that maybe out of the Nifty 50, at least 40 to 45 stocks are closer to or trading past about their previous lifetime high levels. So, but that's not the case this time around. I think the top 7, top 8 names are still struggling to break past about their previous major highs with respect to their previous highs in 2021-22 individually. So I think that's one of the major reasons why the index is taking a bit of a pause in between. I also believe that with every pause on the index, there are new sectors which are emerging. For example, in the previous leg of the up move, you had the private sector banks which are doing exceptionally well. This time around, you have real estate, you have cement stocks which are looking quite charged up. So I think it's a phase. It's a phase of every pause or the consolidation on the indices, where the sectors would keep on changing as well as churning.
The other important development, of course, has been that there is a new expiry date, at least for the Nifty Bank. It's going to be on Friday as opposed to Thursday, which it was earlier. However, for the index, the expiry continues to be Thursday itself. And I guess the rationale was for the two of them to not eat up into each's volumes.
Aisha, let's first understand the whole concept in theory. You got a 1 week buyer and you got a 1 month buyer. And when both of them have a compulsion which happens on a particular day, sometimes the near-term price adjustment and the near-term compulsions in both terms of technicals and liquidity can really have an impact in the way how the 1 month cycle would move. So it's fair that you're taking the volatility out. But let's understand the 3 constituents here. There is NSE, they'll be very happy, more brokerage. The broker here, they'll be very happy because they'll get the brokerage. Will SEBI be very happy? Because what you're doing essentially is you're giving one more window where if you're a real short-term trader, you create you can settle an instrument on Thursday and then you have another opening on Friday. So if it's an FNO expiry, Kunal, just hear me out, if I'm able to connect dots here, on Thursday and you've got a bank weekly expiry on Friday, at least there is a chance of a rollover. And that adds to actually more volume, more brokerage, and more commissions. The idea is to reduce volatility, not to create an arbitrage. And we've seen seen that happen in the past. Remember there was a time when there was a BSE settlement and a Kolkata settlement and NSE settlement. I think the Kolkata settlement used to be Thursday, NSE settlement used to be Tuesday, and BSE settlement used to be Friday. All you're doing is that you're simply adding one more instrument and one more window where you can roll over if you are, one of those, positional traders. See, you'll settle it on Thursday. Earlier it was a compulsive settlement. Now you may say, okay, I'll not settle on Thursday. I'll roll it over from Thursday to Friday, and I'll see to it the next Friday. You're just creating.
Nifty Bank.
Yeah, that's only one instrument you can move. And Nifty Bank is the heart of everything right now, considering it's become a very large instrument. Could it be also opening where they will come out with something additional on Nifty also? I think this could be a window, this could be move in that direction. So I'm not sure if SEBI is going to be happy, but NEC is going to be happy. And brokers are going to be happy. And Kunal Bhutra will give us more trading ideas in how to roll over.
But Kunal, practically, how does life change for you?
It doesn't. It doesn't. So, Fin Nifty, the financial services index on the Nifty, the expiry for that is Tuesday. So now, and that's a weekly, monthly expiry. The monthly expiry for Nifty is now Thursday, and the Bank Nifty is now for Friday from the July series. So I think it doesn't change life as such. But yeah, I think it's going to be a lot more cumbersome to trade, because you have to remember that on Thursday you're just looking at the expiry of the Nifty futures and the Nifty options, and on Friday then you are looking at Bank Nifty futures and options being expired. So
remember that NSE Tuesday settlement and BSE Friday settlement, the positions were first rollover from NSE to BSE because you got the additional 3-day window. So my limited point is that you actually get a window now. If you do not want to compulsory settle, let's say if you're a Bank Nifty long, and if you do not want to settle your positions, whether it's long or short on that Thursday, you can roll it over to Friday, and then that gives you another 5-day window. So it's actually more brokerage, if you frankly ask me. That's my limited view. Kunal is ready. So Naresh is ready?
Yeah.
Naresh, you want to come in on this discussion?
So this is the progress which is happening across the world. So for example, S&P 500 has a 1-day to expiry lot for almost 5 days a week. So we have we've started with Thursday being Nifty, Friday being Bank Nifty, Wednesday is Nifty Mid Cap 50, Tuesday is Fin Nifty, Monday is left. So the joke is now Monday is the new Friday. That is the only day there is no expiry. And soon there should be some other, say, instrument coming in, say maybe a Nifty IT comes back again. But overall, what we are seeing is a lot of volumes are happening on the 1 day to expiry. The expiry day volumes have been increasing on all the instruments. So Fin Nifty was illiquid when it started off. Today it is very liquid. So NSE is playing to the audience who want to speculate on every day. So now traders who are a single day expiry traders now get to trade Nifty on Thursday and Bank Nifty on Friday, increases the volumes of the exchange.
Executive Director, Financial Services, Equity Research with Morgan Stanley joins us now. Morgan Stanley is having the big annual conference here in Mumbai, and we are exclusively trying to understand the real messaging to their clients and what they currently are indicating in terms of a theme, approach, idea, and where the future of the economy is headed. Samit, good morning. It's your first time, at least I'm interacting with you on this forum. So lovely to have you. I keep on reading and enjoying some of your reports. My first question is that there is perhaps a universal consensus that the banking sector in India is in some kind of an uptrend. Credit growth is strong, NPAs are low. But do you think this consensus from a stock market standpoint is baked in?
Yeah, thanks for having me on the show. The banking sector, I think so, is on an uptrend. I agree with that. What you're going to see is some cyclical moderation in margins and credit cost. But the more important thing to look at is that the return ratios for Indian banks will still remain above normalized levels, at least for the next couple of years. The other reason why I agree with your view is the credit cycle. What we have seen more importantly over the last 2 years is normalization of credit in, say, retail segment, SME segment, to an extent the working capital requirement of corporate India. What we have still not seen is a pickup in private corporate capex cycle. You look at the balance sheet in India now, corporate debt to GDP has come down quite meaningfully over the last 15 years. They're completely delevered. Banks have seen a sharp reduction in bad loan ratio. The coverage ratio has improved quite meaningfully. The government has taken a number of initiatives such as PLI. Look at the corporate capex announcements that have happened over the last 1 year. The stage is set for a very strong recovery in private corporate capex. it may take some time. There could be a delay of 2-3 quarters because there are elections pending. Global environment is slightly more tricky, so the implementation may take time. But this recovery in credit cycle is not going to be just 1-2 years. We think there's something which is going to continue for the next 3-4 years. And as you see credit cycle, credit growth pick up, the banking sector can continue to do very well.
What is your understanding of how many quarters more this credit cycle will last? Why I'm asking you this question is that if I only look at, let's say, State Bank of India, they've hunkered down their credit growth numbers. I spoke to the chairman of CEO of Axis Bank, Amitabh Chaudhary. He also is of the view that credit growth is slowing down. That's part one of the story. Part two of the story, interest rate cycle is nearing its ends, which means peak of the NIMs are also behind us. So are we not in some kind of a deceleration with a moderate growth rather than high growth?
So yeah, I hear where you're coming from, and that's completely right. See, over the next 2-3 quarters, you're going to see a couple of cyclical changes. So margins that has improved quite meaningfully for Indian banks, and over the next 3-4 quarters, margin will come down. But remember, even as margins come down, and if I look at the exit margins in fiscal 24, they're going to remain much higher than what we have seen in history. So am I comfortable that margins are way above normalized levels? I should be happy about that. Credit growth, yes, we have some base effect that'll come from last year. Last year, same time, the working capital demand had gone up quite meaningfully because of inflation. As inflation moderates, there'll be some deceleration in corporate credit. But I'm just trying to think that should I worry about some short-term deceleration over the next 2-3 quarters, or think about what is going to happen over the next 2-3 years as and when private corporate capex picks up? The more important thing which I want to highlight over here is the balance sheets that we are operating with. I have not seen these balance sheets for 15 years that I've been covering this sector. As you see more and more capex implementation, the credit growth is not, from a 2-3 year perspective, the credit growth will not only stay at 15%, I think so it'll go above 15% 2-3 years down the line. If I can put one more stats here, 2000 to 2010, if I look at that decade, the credit multiplier in India was 1.5 times. Last 10-12 years, the credit multiplier has been 1. If I look at corporate sector, it has been less than 1. There's no reason why the credit multiplier is not improving. We had put out a report articulating why this is India's decade. Our view is that credit to GDP, which is around 57 to 60% right now, can go to 100% by the end of this decade. So I want to focus more on the medium-term story, which looks very constructive. Yes, there are some cyclical headwinds over the next 3 quarters, but that's fine.
That's the take coming in on banks so far and what the overall construct is looking like. Sumit, just hang on with us. We're going to take a very quick commercial break, but we'll come right back and continue our chat with you.
In conversation with Sumit Kariwala of Morgan Stanley, and we are discussing the future of what lies ahead for the entire banking sector per se. Sumit, the general view with everyone is that big banks have the right to win. They're getting CASA, they have technology, they have management. But these are not the high growth banks. The high growth perhaps is still because of the base with mid-tier banks, the AUs and the IDFCs of the world. In such a strong credit cycle, to your mind, for a stock market investor, which offers better potential in terms of return? I mean, for someone who says, look, I don't mind going down the ladder, I'm not that particular about cutting down the market cap size.
Sure, that's an interesting question. Actually, a tough one when the credit cycle is so good and every bank does very well. What I would want to differentiate is that the current cycle is a lot different than what we saw over the last 10 years. Over the last 10 years, a lot of large banks were going through credit cycle. They were not that aggressive with respect to deposits or lending. And you had, to an extent, edge as a mid-sized bank to grow faster. What is going to happen in the current cycle, and I'm not talking about any individual bank here, but as a group, the large private banks will be able to gain faster market share in terms of loans and also improve profitability at the same time. Scale has a very differentiated advantage in this cycle. Funding is also going to get a lot more important as more and more banks turn competitive. The large banks as a group, they've invested in technology, and the kind of operating leverage that they can drive over the next 4-5 years is going to be quite meaningful. Think about some of the revenue headwinds that are going to come in terms of, say, competitive intensity, regulatory changes, etc. These banks, because they're sitting on a lot of operating leverage, they can better drive core PPOP growth and margin. So as a group, we think large private banks will do better than the small banks. There would be individual small banks, or there would be some large banks which may not do that well. But as a group, we think that this decade is for the large private banks.
The overall general view within the investment fraternity is that it's it's the corporate-facing banks which would win over the retail-facing. But if the view is bullish across the banking pack, then why this differentiation? And do you believe that the corporate-facing banks would continue to win over the retail guys?
So I honestly don't differentiate between corporate and retail in the current cycle. This was something that we used to do for the last 10 years because the corporate banks were going through a very tough NPL cycle, and to that extent they were not able to gain market share or deliver on asset quality. The current cycle is going to be good on corporate and retail, and if I look at banks, they have a fair mix of both corporate and retail loans, and to an extent the growth outlook is interlinked. If you're seeing a lot of corporate capex, there'll be significant benefit that'll happen to the SMEs, to the supply chain. There'll be more hiring, there'll be better income growth. So I think so you will see growth across the ecosystem. The way in which I would want to differentiate is that who has a better funding franchise, because they'll be able to gain faster and more profitable market share. Who has invested in tech over the last 3 years, and who can increase the share of digital loan originations, who can drive higher cross-sell, who can have resilient processes as the bandwidth issues come to the fore. There are the large private banks as a group are better placed, and which is why we have a preference over there. Not trying to distinguish really between corporate and retail banks in the current cycle so far.
I want to pick up a point from your answer. You said that forget about next 2-3 quarters, you expect credit growth to go beyond 15%. And that if it happens after 2 years or 1.5 years, that means you're expecting credit growth to pick up on a very large base. What gives you the confidence that the credit growth could be 15% plus, given that we have an election cycle in between?
Yeah, see, think about it this way. If you look at over the last 10-12 years, when as a country we have gone through multiple crises, that could be because of the corporate NPLs that came through after 2013-14, number of regulatory changes, the NBFC challenges that we faced, COVID, etc. During this period, you had an overall credit growth of 10% with retail and SME growing more than 15% plus. Think about what is going to happen over the next 4-5 years. Retail and SME continues to remain underpenetrated. There's a lot more data available on consumer and SMEs, which is why credit availability is going to increase. These two segments, can they grow at 16-17%? I think so, it's possible. What has lagged over the last 10-12 years is corporate banking, corporate lending. Corporate lending, which has been growing at 5 to 7%, can accelerate to 14-15%. I don't think so. That's a tough ask. Let the private corporate capex cycle come through, and you would see corporate sector growing in line with retail and SME. And it's pure summation. If I think corporate capex cycle comes back, overall credit growth can be running at 15-16%. And this is not something which is very tough. You're talking about a high base, but credit penetration in India is still quite low. And we have seen this when you have had corporate segment do well along with retail and SME. We have seen credit growth of 15-16% in the past. I don't think so that's a very tough number. Yes, the key ingredient is private corporate capex, and as that comes through over the next 2 years, one should not be that surprised.
One of your mails, one of your reports, 10th of May, it has your name, it's been authored by your team, the ECL guidelines. There's a lot of confusion on what would be the impact of ECL guidelines, at least on PSU banks. And Morgan Stanley, what is your house view?
Yeah, so I think so the numbers that have been given by some of the state-owned banks with respect to ECL doesn't pertain only to ECL implementation, but a number of other changes that might happen as part of IFRS, and the banks have clarified that. Our assessment of potential ECL requirement at state-owned banks would be around 1 to 2% of loans, 1% for the stronger banks, 2% for the less stronger banks within our coverage. What also needs to be understood is that the provisioning coverage ratio at Indian banks have improved quite meaningfully over the last 2-3 years. If I would have done a similar exercise, say 2-3 years back, the number would have been very different. And the credit cycle is going to remain benign over the next 2 years. So as these banks continue to build up coverage ratios, the numbers can come down further. But based on the current numbers, our assessment will be that it's 1 to 2% of loan book.
Right. Okay, Sumit, great to have you on the show today. Thanks so much for taking the time out, and have a great conference.
Thanks a lot.
Okay, that's the view on banks and financials. Quickly monitor where the market is currently at. Still just, skirting around 75 odd points lower for the futures. 18,622 is where we're currently at. But it's really the cement pack which is all guns blazing right now and continue to hold on to very, very strong gain. Of course, the moderation in raw material prices is what's really aiding the move on the sector. So everything from an Ambuja, Shree Cement, ACC, UltraTech Cement, the entire pack is holding a buzz. In fact, Mansi joins in from our research desk to really analyze and break down for us what's aiding the moves within the cement pack.
Cement sector is buzzing in trade, and we have a lot many reasons for them. But to start with, the moderating raw material prices is what we are going to talk about. The international coal and pet coke prices have continued to show a declining trend, which is helping the sector. At present, if we have a look, the coking coal prices have fallen to 2 years low, and the average coking coal prices is trading at the lowest level since September 2021. Yes, in May 2023, if we have a look, the coking coal prices were down by $9 per ton, which is a dip of around 14.6%. So the average price of coking coal at present is $198 per ton, which is constantly reducing. The declining trend is helping the sector as the cost for the cement space is reducing. Not only this, the other factors which are helping the cement sector are the expectations of GST cut. There are anticipations that the GST on cement sector, cement companies will see a cut from 28% to 18%. So clearly it's going to be a win-win for consumer as well as the cement company. So this is the expectation which is doing rounds. It might come in coming days. At the same time, if we have a look at the demand trend, demand is strong. Cost trend for the sector is staying elevated, and no increase in global pet coke capacity. At the same time, the volume and capacity utilizations are also expected to pick up. Again, pre-election year will give a lot of footage to the cement sector, because cement, road and infra are the spaces which will see a lot of traction during this time. So all in all, many very factors which are helping the cement sector at present, and the latest one is the constant declining trend of the international prices of pet coke.
Very simple. Coal prices are an important raw material. Why are they important? Because in cement manufacturing, you use a lot of coke to burn and to create heat. That's the process. And if coke prices or pet coke prices have come down, and they've really come down like how 25 to 30%, which means in the coming quarters, this quarter and the current quarter, for some of the cement companies, there are two costs which had hit them last year: high commodity inflation and high transport prices, because cement is a mass commodity. And if those commodity prices, and if that comes under check, then we are looking at a disproportionate amount of advantage coming back. And the deeper you go in terms of companies which have scale and size, they are going to be the biggest beneficiary. So for example, Ambuja, it's got plants in the port, big beneficiary. You got UltraTech, they are able to buy in bulk, and they have an all India spread. So they again would be disproportionate beneficiary. Landlocked companies may not gain that much because transportation cost has not come down dramatically. But on one vector, which is the entire cement met coke prices, I think it's a great situation for them. Shivani Sarkar Kurian joins us now. Let's connect with her to understand and what she makes of the current market mood. Shivani, good afternoon. Thank you for joining us. We are almost at a new high on the Nifty, almost at a new high on the benchmark indices, which is Nifty 50 and Bank Nifty. To your mind, what is driving the markets and what is the way forward now after the recent rally?
Having me here. My pleasure. So you're right that markets have been moving, and if you look at the last 1 month, what we have clearly seen is that has been standing out from a global perspective, especially where macro parameters are concerned, and that has been one of the key reasons while Indian markets have been very, very resilient and have inched up closer to previous highs. Earnings delivery has also come through in the fourth quarter, where numbers by and large at a headline level have been in line with expectation, and that has also been one of the key factors that have driven markets. Now, from here on, when you look at two key parameters, one is valuations and the second is earnings expectations for 24 and 25 in terms of financial year. One is valuations are at about fair value levels. So on an absolute as well as relative basis, we are at about long-term averages. So valuations are not expensive and neither are they very cheap. And therefore, going into FY24 and 25, earnings delivery becomes extremely crucial. Our belief is that if you look at consensus estimates for both these years, mid to high teens earnings growth is something that is being factored in. And this growth is possible given the kind of overall demand as well as growth that we are seeing, especially where domestic facing sectors are concerned. However, when you look at the broader market and we look at beyond Nifty 50, what we've also seen this quarter and in the last few quarters is that earnings dispersion at a sector level as well as a stock level has been fairly high. And therefore, when you look at the broader market, there is likely to be dispersion in terms of earnings delivery. And therefore, stock picking and looking at the sectors in terms of where the earnings growth is coming from becomes extremely important. We believe that in this market, domestic facing sectors continue to be better placed than global cyclicals and global sectors. And therefore, even in our portfolios, our overweights continue to be industrial, capital goods, banking and auto and cement to name a few, while we continue to be underweight on metals and technology at this point in
time. We were discussing cement stock, Shibani. Is there merit in buying into cement because commodity prices are down, infrastructure spending is picking up, 6-8 months ahead of the election cycle, the entire activity on ground also has to pick up?
Absolutely. So cement has been one of the sectors where we continue to remain positive on. So cement is both a proxy for infrastructure as well as housing construction, and both these segments have seen improvement. And that is already reflecting through in terms of the volume growth that we are seeing in the sector. So even in the last quarter, most of the companies have reported fairly strong volume growth. And as you rightly pointed out, typically what we have seen is in a pre-election year, you do start to see pickup in infrastructure activity. And as it is, the policy focus has been towards investment and infrastructure-led growth. And secondly, housing market has also started to see improvement. So real estate activity has improved, which is again bodes well from a demand perspective. On the margin front, two factors. One, of course, the input cost pressures have come off very, very sharply, and that helps in terms of margins. On pricing has remained largely stable. So, of course, going into monsoons and post-monsoons, we have to see how the pricing holds up. But with pricing remaining stable and with input costs coming off sharply, margins are likely to improve as well. And therefore, this is a sector that we believe should continue to deliver in terms of improvement on profitability and remains one of our overweight in our portfolios.
Shivani, also the auto space, as competitive as it may be getting, but, purely in terms of stock market, there seem to be some standout winners there, right? Tata Motors, M&M, etc., at least within the passenger vehicle segment. Wanted to understand how the two-wheelers, CVs would come into the fray and investment-wise, what's the space that you're liking right now?
So again, auto as a space is something that we have been positive on for a while. What we have seen in terms of improvement, both in terms of the CV cycle as well as on the passenger vehicle cycle, we believe that this is normalization of long-term growth post a multi-decadal low that we have seen over the last few years. So there is still some room for improvement from here on. Now coming to the two-wheeler segment, the two-wheeler segment had been extremely muted, but now we are starting to see some signs of recovery. And this is essentially coming through with nascent recovery in demand, especially from the rural markets. So the two-wheeler space is something that we find fairly attractive at this point in time. Also, if you look at from a company-specific perspective, there would be companies that we would want to monitor, especially where product launches go. And therefore, the product launch cycle also has a pretty important role to play where this sector goes. A third aspect from a sector perspective is, of course, the margin factor, especially with decline in terms of commodity and input cost pressures. And what we would also need to monitor is the normalization of the chip availability cycle, which should over a period of time aid recovery across the board. So the auto ancillary pack is something that we continue to remain fairly positive on. And we are looking at players who have a large pipeline in terms of product launches. And the two-wheeler cycle space at this point in time, especially given valuations, also continues to look attractive.
Okay, Shivani, great to have you on the show. Though on the subject of the entire auto pack and the product pipeline, it's actually Honda which is now latching on to the entire SUV frenzy. They're looking at launching 5 new SUVs by 2030, and today they launched their brand new offering called Elevate, for which the bookings are going to begin next month and the delivery is going to be in the festival season, September to November period. So that's Elevate, the newest offering from the stable of Honda. But we're going to take a very quick break. Come right back. We'll continue tracking markets on the other side. For closing trades, right here on ED now, still quiet. Still, it's really the cement pack which is holding a buzz. Although Ipca Labs is the one which is really on a tear right now. 4% higher for Ipca Labs as you speak. Hindustan Aeronautics has been going very strong. That's the other buzzer in trade. And for, I think, a second consecutive session, it's been seeing some very solid gains. 2.6% higher on the futures. And then Glenmark Pharma as well, which has suddenly spiked up. If we can just bring up the intraday graph, 2.25%. And this move has really come in the last half an hour or so, as you can see on that graph as we speak. But let's stay with the overall markets. And now Morgan Stanley in its latest report says that it actually sees a 30% chance for the Sensex to hit 80,000 levels over the next 12 months. Ashesha is here, who's scanned through all of those notes and joins in with the latest. Ashesha?
Well, yes, Morgan Stanley has come out with this very interesting report where they say that Indian markets look attractive despite the rich valuations that Indian markets are trading at. In fact, they've given a target price of 68,500 on the Sensex in a base case scenario. And as far as valuations are concerned, they say that Sensex will trade at a trailing price to earnings multiple of 20.5 times versus its 25-year average of 20 times. And this premium is justified given the medium-term growth story of India. In fact, they say that India's standing in the world order is rising and local stocks remain attractive despite their rich valuations on strong earnings growth prospects and a swelling bid that we are seeing from both domestic investors as well as foreign institutional investors. They assume Sensex earnings compounding at 22% annually through FY25. They are preferring cyclicals over defensives and small and mid-cap stocks over large-cap stocks. As far as sectoral preferences are concerned, they are overweight on financials, technology, consumer discretionary and industrials. So for now, they've given a target price of 68,500 on the Sensex in a base case scenario and 80,000 in a bull case scenario.
So also joins us now. Before that, NHPC, that's National Hydro Power Company. I mean, they make water out of hydro plants. It's not a very popular, it's not like a very big power generation business in India because you don't have that kind of a natural landscape excepting in the hilly area. And that's where, after a couple of floods which happened in Uttaranchal a couple of years ago, government is really going easy. Now they're setting up a 7,350 megawatt energy storage renewable energy source. I think we need to check what it means. In my understanding that it means that they're moving into some kind of an energy storage business. Kunj Bansal joins us now, CIO with investmentliteracy.com. So Kunj, what's next for the market? 10% plus for the Nifty, 12-13% plus for the Bank Nifty, and everything has happened in less than 3 months.
Yeah, so to start with, just a correction, I am with NISM now, National Institute of Securities Markets. Yes, coming to market. Um, so every time the market goes up, we obviously, all the market participants broadly put together tend to extrapolate that it will be either on an Excel sheet or even without Excel sheet, plus 5% in another 3 months and yet another 5% in another 3 months. And same happens when it goes down also. If I talk of the current Nifty level of 18,500, 600, we were there at this level in November, December. And so effectively in 6 months we haven't moved anywhere. In fact, if at all, in this duration of 6 months, we actually went down 10% to about 16,900 odd or so. So market is like that. After a sharp rise, it always tends to consolidate. It should consolidate. In fact, what we have also seen that we start every year, financial year, with a quite optimistic earnings expectation, anywhere in the range of 15 to 25%, depending on the survey of varied range of market participants that we take. And effectively for last 3 years, we have been ending with almost a 10% kind of growth rate every year, including in the recently ended financial year 23. The Nifty EPS has come close to around 800, which is roughly about 10% growth from FY22. I think that's what will market continue to do. It will consolidate at current levels. It's not that it's going to go away. We have already seen a 10% rise in last 1.5 months. At this point of time, valuations have started to become expensive. But within that, sectoral rotation will keep happening, number one. Number two, the companies or the sectors whose performance was relatively better for March quarter numbers and the participation wasn't there will keep coming in limelight.
Look at that dot now. Nifty is recovered almost at the highest point of the day. Are we likely to snap out of this range? We've been in this range for 6-7 days now. Are we likely to snap out of this range? Gravita India, another block deal. I mean, we know that a lot of smart guys have bought into this. It's into waste management. I think it's based out of Jaipur. I don't track it that much, but that's Graphite India. We need to look at Gravita India, and that's Gravita India for you. Thank you. 603 rupees for Gravita. I want to look at Reliance. It's popping right back up after a early morning selling. Then you got Tata Com, which is right up there. For some strange reason, Zomato now seems to be it's a pattern Zomato follows. Flat for first half of the day and then recovers in the second half of the day. You've seen this pattern? Like last couple of trading sessions, it remains flat, 2 o'clock. Just observe it. I'm just checking the chart. I track the stock closely. So it's just been a stock which just has this very unique pattern, so to speak. But Reliance, is it finally coming back?
I don't think so, Nikunj. The charts, the indicators are still very, very sluggish. Looking at the RSI at level of 40 to 45 band for Reliance Industries over the last 5-6 days gives a sense that it's a very neutral kind of a territory for the indicators. The MACDs come back into that neutral line for Reliance Industries. So, when we're trying to anticipate that whether there's any kind of a price move, we anticipate that the first move actually gets shown by either in terms of volumes or indicators. But in this case, it's absolutely, in a neutral kind of a territory. Very difficult to preempt any kind of a breakout unless you see some kind of a price action leading the change.
Nuresh, no Reliance, no HDFC Bank, no Infosys, and markets are 200 points away from an all-time high. Looks like this time markets will make a new high without Reliance, without HDFC Bank, and without Infosys.
So that is where the problem is. If we make a new high without it, you also need a much larger move in some of the other names. So if you look at it, we are looking at an Axis Bank coming close to an all-time high. ICICI Bank is just a little away. The auto names are hitting new all-time highs like TVS Motors, Tata Motors, a lot of these names, but they do not have a very high weightage. So the problem is if 40% of the index does not make a move, how do we get the 100% the whole index make a larger move? So waiting out for at least one of these 6-8 names to start taking leadership. Otherwise, it will be a slow and slower ride towards that 18,800, 900 mark. So once at least one of them wakes up, we could actually see it happen in the day itself. So overall, the bias is positive. We are seeing more momentum stock specific. So the view is one stock out of the heavyweights comes in and we go to 18,800.
No, if I'm looking at CMS stocks again. You got Keynes, you got Shirma SGX, you've got Dixon, you've got Amber. Shirma SGX popping right back up. Dixon, no, it's not popping up. Keynes has popped out, and Amber has not popped up. Kunj, what is the go-to sector for this year? 2021 defense, 2022 railways. Could it be EMS this year?
So EMS is a relatively small sector. It might as well, it might actually outperform. There's no doubt about it, given the way the businesses have been growing, given the way the commodity prices have corrected. And thirdly, the way the supply chain issues seem to be getting sorted out. So that's quite likely. Of course, there is a government support by way of PLI scheme. So yes, EMS sector is something that could be an outperformer. Also, let's keep in mind that it has been an underperformer this year. In fact, most of the shares are down from their life highs or 52-week highs. Given the recent relatively lackadaisical financial performance that they gave in last 2 quarters, in some cases it was December quarter which was bad, in some cases it's the March quarter which has been bad. But I think if I look at it from the complete financial point of view, for me it might as well be cement. The reason being that the volume growth seems to be returning little bit if we go by the secondary market checks. Of course, the monsoon will be the critical determinant. So post that we will have to see. But importantly, now they have started to get the benefit of the raw material price correction. In fact, significant price correction in things like pet coke, etc. So that's where there could be a sharp outperformance coming in the financial year, more like as a contra approach in the market.
Get a pulse of what's happening intraday though in the markets, and Sharad has been scanning the phones on the dealing rooms. He joins in with all the chatter. Sharad?
Well, yes, in focus we are having Sharda Cropchem, and what we are hearing from dealers is domestic FI buying has been seen in the stock itself. The stock has been one of the top gainers of the Nifty 500 index, and the existing domestic institutional investors include HSBC Small Cap Fund as well as DSP Mutual Fund. Now, we did have a channel check, and what we are hearing is that normalization has happened of the inventories, and especially if we take it from the December quarter, that has actually come down to 25%, and it was as high as 70% in the month of December. Apart from this, also the management has stated that the company is expecting the inventory normalization to actually kick in by the second quarter of FY24 itself. But do remember, agrochemical stocks have been rallying of late, and this is because they are factoring in the inventory rationalization going ahead. And the company itself deals in the procurement of products from China, and they buy it in dollars. And do remember, the prices in China have been falling of the agriculture products, and that is actually aiding the company's margins as well going ahead, and that's what the analysts have been stating. Now, overall, if you look at the outlook itself, the company, the management has reiterated the guidance that a top line growth is expected to be of 15% plus of sales growth, while the EBITDA percentage is expected to range between 18 to 20 odd percent. Also, lastly, the high margins business which comes from Europe, that is also expected to remain strong going ahead.
Sharad, thanks for all that buzz. Yes, Sharda Cropchem is one of big movers in trade today. In fact, the stock is now holding up in excess of 10% as we speak. There you go, 10.6% higher. 555 is where that stock is. But let's get in some BTST trades as well going before we wind up for the day. Naresh, on your list?
So that would be a buy on ACC. We are seeing good momentum across the cement pack. ACC is lagging behind a bit, so good risk reward trade here. A stop loss at 1835, target price of 1950. Second is a buy on Hero MotoCorp, sustaining about the 2900 mark. Stop loss at 2880 and a target price of 2980.
Kunal, what about your BTST ideas?
So I'll bet on Sun Pharma as one of the first pick, suggesting a buy with a target of 1080, stop loss at 980. And L&T Finance is also one of the stock which has moved up to now 105 plus mark. So a lot of consistency in terms of price patterns. Buy with a target of 111, stop loss at 103.
Well, what's really been catching our fancy, considering the markets as well are turning out to be at least at an index level pretty, listless, is actually Apple and all the new launches which have come about from the house of Apple. They kickstarted their 2023 Worldwide Developer Conference, announcing the new augmented reality headset, the Vision Pro, which is priced at $3,500. In fact, let me take it across to Ankita and find out what are all these new launches and what are they looking like. Ankita?
Yeah, why would...
Well, that's right. Apple had kicked off its 2023 Worldwide Developers Conference keynote yesterday, and here's a list of announcements made by the tech behemoth. Now, the Apple announced the much-awaited Vision Pro that starts at a whopping $3,499, a 15-inch MacBook Air for $1,299, Mac Studio with M2 Max and M2 Ultra for $1,999, and a Mac Pro with M2 Max and M2 Ultra for $6,999. Now, besides the Vision Pro announcement, Apple also unveiled the iOS 17, which is the latest version of its iPhone operating system that will be available in the autumn this year. Besides, they announced an iPad OS 17 for iPad Mac OS, a Sonoma for Mac, FaceTime for Apple TV, and a Watch OS 10 as well. Now, amongst the whole host of these announcements that they made, the one that really made the headlines was the announcement of the augmented reality headset Vision Pro, which is likely to be released early next year in the US and will cost you a whopping $3,499, as I mentioned. Now, it is also the first major hardware release after the Apple Watch device in 2015. Now, the market didn't seem very kicked about the much anticipated Vision Pro, as the company's share prices fell during the announcement, as you know, the extremely high price point and the immediate shortcomings as a first generation device could act as a deterrent. But having said that, Apple is known for, it has a track record of making people loosen their purse strings to add new Apple gadgets to the repertoire. So it is going to be a wait and watch.
All right, now it's a different way of looking at the world. That's what this device is going to do. Imagine, if I wear this lens, how will Nifty look like?
The same.
The same.
Three-dimensional.
Three-dimensional. So better technical analysis, better
But the
understanding.
levels will
more
remain
depth.
the same.
Levels will not change. That is more important.
Yeah. But yeah, it's quite expensive though. Maybe that's why the prices of the share
No, stock touched all-time high last night.
Okay.
It must be in the pre-open session.
Maybe in the pre-open
in the
rates.
post-open session.
Yeah.
Apple touched a record high last night. That's what I remember. What do we have? 24 points higher on the Nifty, 86 points up from the day's low, and we are almost at the highest point of the day. And Kunj Bansal, imagine you joining us on a show after a couple of years wearing a VR of Apple. And then I'm asking you to predict the future. How cool would that be? I mean, I never thought that we would be able to use, Skype and Zoom during COVID for running a channel and interacting with guests. But technology has done that. So I will not be surprised that, future guests could be wearing VR and giving us different experiences, how they look at the world.
Yeah, so I'm still apprehensive if any of these equipments will be able to tell me the index levels 1 year down the line from X date, 2 year down the line, and 3 year down the line with 100% accuracy. So that's where let's hope if the technology can move. But on the other side, if that moves, then the returns will anyway come down or won't be there, because everybody will have the technology and everybody will know those index levels. So some things will remain the exclusive domain of the human intelligence, human intellect, and human mind. You can give a lot of inputs as to expected growth rates, expected P valuations.
It's an article which is authorized by one of the global newspapers that fund managers globally are struggling to even beat ChatGPT. I'm not saying it. It's an article. I can share it with you.
I've also read that article. So, but we are talking of two different things. One thing is technology beating the existing participants. The second thing is technology being able to predict with 100% accuracy what will be the return, what will be the index level. So these are the two things, but I won't be surprised if it comes also. As I said, but if it comes, then the returns wouldn't be there because everybody will have that technology. It's a matter of you being able to afford that. And even if 100 entities in the world afford that, they all know that where the indices are going to go and they will accordingly take the positions. So the returns would come down. But nonetheless, that brings us to the important point that today the technology shares are down in Indian market. And such kind of corrections will keep coming. I think IT sector is a sector which will keep getting opportunities based on the multiple research, multiple work being done in varied areas across the technological spectrum. So that's one sector that I think for as Indian participants, we can certainly take a key takeaway from. that that's a sector that's going to give us certainly 15% kind of annualized growth rate, annualized share price performance return from the good companies in the next 5-10 years or so.
Okay, Kunj, we'll let you go on that note. Thanks as always for joining in. And let's begin winding up for the day then. It's really been a nothing sort of day. From the high to the low, we haven't moved around too much. We're closing down about 39 points or so. Definitely managed to lift off from the session lows, however. So back at 18,600 for the Nifty, 18,684 for the Nifty futures. Ultratech Cement, you had Ambuja, Shree Cement, Ultratech, they all held out very, very smartly, as did a JK Cement, Ramco, Dalmia Bharat, India Cements. These were all the big winners in today's trading session. Divi's, Tata Motors, Axis, Maruti were some of the other performers. And then, of course, from within the broader end of the market, and Ipca Laboratories, Hindustan Aeronautics also were some of the stocks which held out. Technology as a pack was the one which really was the laggard today. So TechM down about almost 2.25%, Infosys, TCS, Wipro, HCL Technologies, along with, of course, Persistent, Coforge, Infosys, they all were the ones which were the laggards. IEX as well lost about 4% in trade. Then there was Voltas, which has also lost about almost 3% in trade. But yeah, besides that, you've seen some decent amount of OI build up, at least within the cement pack. I can see JK Cement, which has seen about a 23.5% addition. That stock, of course, goes home as a winner, part of the rest of the cement pack. BHEL as well. The stock has closed lower by about 3%, but has seen a 15% OI build up. And then, of course, some of the technology names, financials as well, were part of that list. But that's it pretty much for the day. Let's hope tomorrow we see some action, or even if we chose to consolidate, that's also pretty okay. We'll see you again with the market action tomorrow morning.
Co-powered by Bank